Okay, welcome to the Sleepo Portfolio Q&A meeting. This is the 12th of October, 2022, so welcome. We were just talking about the CPI numbers that are coming out tomorrow. We had the FOMC minutes today, which are released 3 weeks after the announcement in the Fed Chair Conference. Usually doesn't move the market too much because it's already kind of baked in. They already know what they did. It's just they're looking for nuances in the wording. And the market moved a little bit today, but not too much. But tomorrow's CPI number, like you were saying, the consensus is 8.1 year over year, and the range 8 to 8.2. So we'll see where it comes in. What
Yeah,
what do you what do you think it's going to do?
so there's been a lot of error in even my models that are kind of pulling in, which my models are anywhere from 7.9 to 8.1 really. So now my models are aimed a little bit lower. So I guess I wouldn't be too surprised with a print that's a little bit lower. But with the PPI that came in today, the recalculations even on my model kind of pulled it back up into line, which is pretty close to where the street is expecting, around that 8.1. So we'll see if that ends up coming out and everything being true. But
Here's the PPI, by the way.
yeah, so which was yet again just a little bit hotter than expected, 8.5 rather than the roughly
Consensus
8.2 or so that.
oh, the 8.4. Yeah.
Yeah, okay. So consensus was 8.4. So that's fine. Not too anything crazy. But PPI is one of those things that can give you just a slight early warning sign to what's going to happen in the CPI, but it's not, they don't translate perfectly. So it's not like, hey, PPI was high, so CPI is going to be really high. It's what things matter to our investments, right? And so if CPI comes in just insanely lower, right? That would be what, right? And that's kind of what I play out in my mind. And I mean, I know what my models quantitatively will do if that's what happens. But as far as, just my mental status, right? Where are we in the cycle? And by the way, for anyone that hasn't heard by now or isn't part of my service, we are clearly in the collapse stage of the cycle now, which is the third stage in a recession. So we're about halfway through, everyone. And so when we hear, hey, inflation's coming down pretty aggressively, that's actually where I start to get a little bit more concerned. When inflation really drops off hard, that's when you can, I'm not saying that it's happened or it's going to happen, but you can get a flight into bonds. And in a tightening environment like what we have right now, there's no new money being created. So in order to reallocate into the bond market, you have to pull from somewhere. And where are you going to pull from? Well, you're going to pull from stocks, right? If inflation stays high, then so if it prints a little bit higher than what we're anticipating, right? Then you have the other aspect of things, which is then asset prices can stay a little bit higher due to inflation. But alternatively, you have a Fed that is probably going to continue to tighten still aggressively. And they're not going to slow down anytime soon, which they shouldn't anyways. But then what you have is then tightening market conditions continuing. And that's pretty bearish for assets, or at least equities. So in kind of both situations, you have a rough time for equities. And so in general, over the next 3 months at least, you can basically say that there's a pretty strong bear case for equities pretty much all around the board. Either way you print, whether you print down CPI or up CPI, equities are pretty screwed right now. So yeah, regardless of what happens tomorrow in any kind of excitement way, it's pretty much slightly down. Now, I don't think that we're going to be in a crash situation. I mean, I'm not saying that it can't happen. But, down is down, and, we'll probably eventually reach the levels of maybe 2018, beginning of 2018 in the S&P. That probably wouldn't be unreasonable. So yeah.
Yeah, here's a daily chart of SPX. See, what's that
There you go.
high-low session thing? Turn that off. So yeah, we're definitely below here, and we've kind of broken through this one even. So it's hard to say. It depends on, I guess, if the number's too hot, then the market's probably going to sell off. What do you think? Because then
Yeah,
the
and
Fed's probably going to have to keep being aggressive.
so, I know a lot of traders, we get pretty excited about like confluence of things, right? And so, I mean, you can kind of look at where we are right now, and you can sit there and technically you can draw a channel on the downside, and you can say that we're on a downswing within the channel, right? And that channel is probably going to continue. And then we're at lows, slightly breaching them. So, and we already tested them already. We tested the previous lows back on June 15th or June 16th, I think. So we tested those, broke through, bounced above. That should have gave us a ton of energy to the upside. But alternatively, that was actually a really great time to short. So, because everything was really overblown to the upside. So then you can kind of short it on the way down. So you've got this confluence, right? And then at the same time, you're still in a tightening macroeconomic environment. You're still in a high CPI environment. So, and a high PCE environment, right? So if I guess the hope out there, right? This hopium that we always talk about,
I don't like
this
the hopium.
hopium of the Fed pivot and everyone trying to catch the bottom of this stock market. I mean, everyone's early. You guys are way early that are talking about a Fed pivot. And I'm like, Fed does not pivot at an 8% CPI, right? It just
Yeah,
doesn't
you're trying to
happen.
catch a falling knife that's still falling pretty hard.
It is. It is. It's really difficult. Now, I mean, are we going to have swings up and down? Sure. Even in bull markets, we have swings ups and downs and, everything like that. But I mean, we are clearly in a solid recession. We've been in a solid recession since we talked about it in October of last year. That was a little early, but it's just is what it is. And it's not turning yet. It's definitely not turned yet. And you'll see, I promise you, like if you're on, either part of the service or you listen to us talking on the Q&A or anything like that, like you guys will know when I shift, right? Like when I'm like, oh yeah, no, it's going to look good from here on out, right? Like, but right now that's not the
We're not
case.
there.
No, we are definitely not there. So the way that so I invest with my portfolios, the Sleep Well, Awake, which have done a really, really good job at preserving capital this year in basically an environment where every asset out there has just basically gone straight down. Every traditional asset, I should say, gold, commodities, oil, stocks, bonds, short-term bonds, long-term bonds, everything has basically gone straight down, right? Tech sectors, everything. The only thing that I think has actually gone up well this year has been like the energy sector. So in an environment like that, we've done a really good job at preserving capital. And man, I just tell you what, it's going to get really exciting on the backside of this thing because, a long only portfolio when every single asset has basically been reset and repriced, ooh, it's going to be fun. So, but we're not there yet. Yeah, back this out just to kind of put this into perspective where we are. Tom, can you back this out to like, I don't know, a few years? Yeah, there you go. Okay.
Weekly,
So,
or I mean, how far
yeah,
back do you
go.
want to
Yeah, there
go?
we go. So, everyone sits there and goes, okay, when is this thing going to be over? Right. I mean, let's just kind of look at this
2400.
and, well, yeah, gosh, that would be, oh, it's a brutal drop. If
I know
that's the
Leslie in
case.
the technical analysis trading group, just based on technical analysis, he was thinking 3000 is reasonable.
Um, yeah,
Maybe 3200, somewhere around here.
yeah, it kind of depends. Okay. So it it all depends. Well, there's a few things, right? There's there's the earnings collapse that we're in right now, which everyone's going to see that here during this earnings season that no one's talking about yet. I don't have no idea why no one's talking about the crappy earnings that are about to come out. But we're going to have the earnings collapse. So that's the collapse stage, right? And then we've got high inflation still. So we still got a tightening Fed. And then we're starting to get these chinks, or these like we're starting to get these chinks in the armor of the financial system. So one thing really big is the Bank of England. Have you
I saw
heard,
some
or has
news on
anyone?
that.
Okay, so this is a big deal, right? So this is the type of situation that we kind of want to pay attention to if there's something major, because when the government has to step in to make sure that there's enough liquidity in a certain market, it's when the tightening is starting to cause some pretty serious pain, and you start to see who had the leverage, right? What did people have to do during this cycle of extremely low interest rates? And what we're finding out is it's pension funds. So these pension funds have been, they needed a certain amount of yield, and they weren't allowed to invest in something like crypto, or they weren't allowed to invest in equities or things like that, right? So they needed bonds. So what they did is they would take out leveraged debt vehicles, and what they would do is they'd basically say, hey, I'll take out 500 times the amount of money that it takes to buy a bond, and I'll buy 5 bonds, and then there we go. Now I'll get the 6% yield that I need in order to keep my payments on the pension, right? In order to keep up with withdrawals on the pension fund. Well, that sounds all great and fine and dandy as long as yields stay down and the volatility of yields don't blow up. But now all of a sudden we have the largest bear market in bonds in the history of finance. I mean, it's especially in the US. Like pull up TLT. That's the 20-year.
Alrighty.
And
There
just
you
back
go.
this thing out. I mean, just to look. I mean, can you get an all time on this? I'm sure you can. Yeah, this has
I
got
think
to be
that's
all
as
time.
far back as it
Yeah,
goes.
2003 is as far back as it goes. Let's see. There's got to be well,
Let me do like a monthly chart. All the
yeah, well, I mean,
bigger
the
bars.
ETF didn't exist back before 2003. So that's why I was kind of like, we really do need just what the 10-year yield was doing.
Here's the 10-year.
Um and how long did the futures go back? 19. Oh wait, yeah, keep going, keep going. Sweet. We've got
81
some
or
pretty good data.
earlier. 80. Yep.
So so the thing that this doesn't show, though, this is what's hard about this graph right here, is that that doesn't look like a large spike down there on the bottom right, right? You're like, oh, that's pretty much in line with with other things that we've had. Well, it's not, though, on a percentage basis,
Yeah, it's like a
right?
4x almost.
It's
4x.
massive on a percentage basis. And that's what we're dealing with right now. This is the largest percentage basis of, bond pullbacks in the history of the United States. So, anyways, so something to kind of keep in mind of, and this is what's blowing people up. And so not only are our bonds cratering right now, but everyone's is, right. Everyone around the world, the Bund, the Bank of England notes, everything. So that's what's causing havoc right now. And the Bank of England stepped in for what, a week. They said, hey, we're going to put a time limit on the amount of QE that we're willing to do. Yeah, that's just a nasty chart.
Wow.
So yeah, that's the
That's a
Fed
1 year.
raising rates.
Yeah.
And the Fed is raising rates at the fastest pace that they've ever done in history also. So I mean, it's just the end of the easy money, high leverage, cheap debt era. And we're starting to see everyone kind of blow up right now. Now, no one big has blown up, right? But some of these pension funds are huge, right? It's very, very similar. Do you remember Lehman Brothers?
Oh yeah, too big to fail.
Right. So we're kind of getting close to that Lehman Brothers era type of feeling right now, because we're starting to put a squeeze on, you know, some of these institutions, some of these pensions, some of these things like that. Now, I'm not saying that it's going to happen like Lehman Brothers, like a bank per se is going to be the problem, because the leverage ratio in the US banks are significantly lower than the leverage ratio in European banks. I I I wouldn't go anywhere near a European bank right now. So yeah,
UUP's
it's
happy.
interesting.
Look at that.
Yes. Uh, I saw your email, by the way, the what's in the chat right now. I saw your email, and I'm actually going to send you that email very shortly. Okay. Um, yeah. So, anyways, that's kind of the whole gambit right now, kind of what's going on, where we are in the cycle. If everyone remembers the four cycles that I talked about earlier, which is the deleveraging, which is stage one of the recession, that was basically January, kind of February time period. Then we get demand destruction, which we just kind of came out of. But like I said, they accumulate, right? So throughout the recession, all previous stages are accumulative until the last recession or the last stage. But anyways, so you got number stage one, which is deleveraging, stage two, demand destruction, then stage three is collapse, and then stage four is injection of new capital and ease of monetary policy, and basically the flush out. So that's kind of where we're at right now. Is we're in the collapse stage, and we just entered the collapse stage. So we got a pretty long slide ahead of us,
How long
and
does that
I'm
stage
thinking
typically last?
the collapse stage is normally the faster stage, to be honest. But it depends on kind of the Fed. It depends on how slow growth is. I personally, the best I can describe this one is going to be kind of a weird one, because we've got a tightening Fed. So you've got the elements of a really fast collapsing stage. So that would be quick, and it would be like really, it would just kind of dive bomb. But because we don't have the deflationary pressure on the backside of this one, I actually don't think it's going to be so aggressive this time around, because the inflation can actually kind of offset it just a little bit. And the deflationary pressures is much harder for stocks to handle. The reason why deflationary is so hard for stocks to handle is because there's so much capital flow going into bonds. I mean, we still might get that through this because we'll get disinflation, but it still probably won't be the greatest situation. And then on top of that, we also have positive GDP that's going to be coming in on the last quarter. So that put together with the positive GDP that we just had this quarter, theoretically should keep the collapse stage from just going into an all-out, crash. And it should just kind of chop and trickle its way all the way down to, pull up the S&P. If I was going to throw a target up here, which I'm not saying this is perfect by any means.
This is monthly. Like weekly,
Yeah,
or
it wouldn't. I would say that it wouldn't throw me off to see the S&P probably trickle and chop its way down to about the 3,200 mark, and then we'd probably be pretty close to being done. So not too much further.
Yeah, it's sold off quite a bit already.
Yeah, absolutely. I mean, it's definitely a lot of wealth has been, vanished. the big thing is that it's not equities that was necessarily concerning anything. It's bonds. The amount of bond sell off is just it's just incredible. So but we haven't had the big like flush moments. We haven't had the big, freak out stage. Even on this pushback, I don't know if anyone's really spazzed out yet. Like I haven't felt like there's been a good solid capitulation moment where they're just like, um, that's
No,
kind of normally the earmarks.
there's pretty good selling after this.
Yeah.
I
Yeah.
mean, if you
I don't
look at a
know. I
daily
mean,
look at a daily chart, we've had a pretty good series of moving down here.
yeah, but that's like I feel like that is
It's not really capitulation
organized.
though. It's
Yeah,
not
that's
like
kind of
panic selling.
organized.
Yeah, it's not
Right.
panic selling yet.
Yeah, and I mean, the VIX is high, so normally you can see panic selling into the VIX. So if you grab the VIX, um, we're at the highs, but you haven't seen that big like whoosh that normally is like, oh crap, it's a
Yeah,
bad.
like one of these guys.
Well, yeah, that'll probably be something really nasty. That'll probably be the collapse of some major bank or
Here's
something.
2008, got up to like 80s or 90 something, it looks like.
Yes. Yeah. So there's the October blow up in '08. And I really don't think, and I could be way wrong on this. I just don't think that we're going to get that.
Doesn't feel like
Um,
it.
yeah. I feel like we're just going to get this constant, just chop, 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 and there's just constant selling off as these banks just continuously are forced to deleverage. Um, unless we have some sort of catalyst, right? You get some sort of big major catalyst and that'll do it. But I mean, I've talked to my friends and everything like that. And it's quite interesting because during the bull market, there would be an event and man, I'd get so many calls about like, oh my gosh, it's blah, blah, blah. It's all coming down. And then strangely enough, this time around, I really haven't had anyone reach out to me thinking like, oh my God, this market's gonna just crash. And I'm like, it's already crashing and no one's even asking me about it. It's quite interesting.
Yeah, I mean, if you look at the daily chart, I don't know. It's the vector down was pretty steep here, but it's maybe not quite as steep here. Like it's kind of maybe trying to find a bottom. So maybe it's going to slow down the selling. I don't know. It depends on what the CPI does tomorrow.
Yeah.
I think if it comes in hot, we could see a 2% down day.
So
I don't,
let's see.
I don't think that would be unreasonable.
Yeah. Yeah. I mean, and no, I mean, honestly, we're starting to get to a level that, we're pretty oversold, but I mean, we can push down further. There's a question in here. By the way, have you tested to sleep well with short rate ETFs or rise for a rising rate environment or short specific currencies slash ETFs? So that is something that is asked very regularly, which is a long short version or some sort of short version of the sleep well portfolio or awake. Originally, when I designed the awake and the sleep well portfolio, it was designed for IRAs and maybe like somewhat self-managed 401ks and things like that, things that people probably didn't have the ability to short in, because that was what was being asked of me from my clients. So what I've been doing lately, so I recently came out with the options side of things, which is more of a retail version of the options trades that I do. And that's over there at etradingedge.com. And then my next step, it will probably be one more element of options, and then I'll get back onto this long short version. I started working on the long short version, and there's lots of promise to it. But of course, if anyone knows how I do things, it takes me a lot of testing and a lot of making sure that things are going to function well and it's going to execute well before I'll come out with a system. And then, typically what happens in history is like, there's a lot of demand for something, and then you'll you'll create something for it, and then the cycle will change, right? The environment will change. So right now everyone's like, hey, I want something very much long short and everything like that, because there's so much short opportunities right now. And yeah, it's anyways, it'll probably be a really hard time to short whenever it gets on the other side of things, which we're probably, we're getting pretty close to there. So by the time I come out with a long short version, it'll probably be, near the end of the bull market or bear market. And, but I mean, this bear market is looking like it's probably going to last all the way until the second quarter of next year, at least. So like I said, long, choppy, slow pullbacks, and we'll go from there. But anyways, I'm working on it. I'm still testing it. There is a lot of promise in some of the earlier models that I have, which are the long short versions. One thing that there are some clients that use is when the sleep well and the awake are not long on something, then they'll take some of their shorting strategies and kind of short them and short things like that, and just kind of trade risk around it. I personally have never like focused particularly on a long short portfolio, because I've always just kind of liked having a long only portfolio, because I trade both long and short myself. So like I've been shorting like a crazy man this entire time. And I throw it on the forums every now and then of like, hey, like last chance to get out, right? Basically kind of me telling everyone that I'm pretty much as short as I could get at that moment. And so I kind of throw it out there every now and then, but that's how I've traded. So for me, it's not like it's been something that I've needed. So I am working on making it for everyone that's been asking for it, which is something that's more passive. The one thing that I would like a little bit of feedback on is for a long short portfolio or something like that, would people like me to leave it at that like kind of 1 week check-in, or do people want a little bit more, right? Do they want to check it every day? Do they want to check it less? Maybe it's, once every month. That has been the one challenge with being short, is that to cover your shorts needs to be pretty quick, because the volatility to the downside, like the reversals, will definitely erode quite a bit of profits. So it's not often that assets trend to the downside. So that's the challenge between a long short portfolio. It's not often that we get a bear market like this, where pretty much all assets just fall. In fact, you can look in history and you can find maybe one time in history, which is the 1973 recession, that all assets went down at the same time. So it's rare. It's very, very rare that this happens. So to design a portfolio around something like what's going on right now, that's long short on a macro sense, doesn't make too much sense. But I'll still work on it. There are systems like Collective 2 that offer auto trading. I would be fine with long short and auto trading. Yeah. How is that Collective 2? So auto trading is kind of an interesting thing. I dabbled with auto trading a little while back, and that was kind of earlier in the technology. But man, it just sometimes it would mess up, or it wouldn't execute properly, things like that. Have you had good use with it, Serge? But yeah, daily rebalance is always fun. What I've also done too is I'll trade around my own portfolio. So like for instance, um like, oh, but with IB, okay, yeah. So what I'll do, like the dollar was really oversold, and the awake got a little chopped out of that. And that's just because of where it is in the cycle, right? We're in a slowdown of the dollar. The dollar should slow down a little bit, but still we're in a collapse stage. So it's still bullish in general. So you're going to get kind of these ups and downs, which is why the sleep well is still long the dollar, and it's been long the dollar for a long time. Those types of things I'll trade around. So when you get these massive oversold, but you've got this macro backdrop of being positive in the dollar, I'll buy the dollar as a trade, right? But I'll risk range around that, which means I can turn it off, the next day if I need to, right? Depending on what happens. Whereas awake and sleep well are done on a weekly basis. So you basically got to lock yourself in for a week. And they were designed that way on purpose, right? They were designed to be more passive, more relaxed. They're trying to they're competing with risk parity and the 60/40. Like, Tom, can you pull up the graph of 60/40 and risk parity
Yeah, sure.
with Sleepwell portfolio, right? And this is an unleveraged asset, right? The Sleepwell portfolio
This
is
one.
unleveraged. So risk parity and 60/40, you rebalance, maybe what, on a quarterly basis. And they've just been dive bombing, right? The S&P, of course, is just something that's completely passive and you just let it go, right? So the idea is can I get midway between that? Can I get a mostly passive portfolio that I'm not going to have to watch on a daily basis? And that's what originally the Sleepwell and the Awake were designed around. And the Awake is a leveraged, more concentrated version. So it'll push more allocation into a single asset than the Sleepwell portfolio will, which is why they'll be different sometimes. So just as a background, that's kind of why those were designed the way they were. Now, coming into it and trying to create a totally different animal, which is great, which is a whole nother product in general, is a totally different animal. One that can kind of unlock some of the potential of some of the more active traders out there. And that's what I've been getting a lot of feedback on is, hey, there's a lot of people that want to actively trade around these things, which is what I do as well. But that's because I'm, near or at my desk enough to trade the markets, and not everyone can do that. So anyways, I'm working on it, and, I can maybe unlock a little bit of that daily workaround, those daily allocations, things like that, especially as the technology's gotten there, like you said, Serge. So daily signal check is back and is preferable. Then drawdowns would be in tighter too. Yeah, drawdowns are tighter because you don't have to let it slide for a full week. Awake version with futures. So can we please get an awake version with futures and short some futures when is in cash? So you can definitely trade awake with futures, by the way. Every single asset on awake has a future equivalent to it. So there are clients that use futures rather than the ETFs, because they have enough size that they're like, hey, look, I need to do this. Keep that in mind also. Like, so if you're trading with, or if you're moving around about $1 million or so, then it's probably not too big of a deal to use futures. But just, if you're trying to move around $100,000 in futures, that's a little difficult because you're not going to be able to get that kind of incrementability in the allocations, right? So try to move a 5% allocation with a future. That's going to be a long shift. Have I looked into an options alpha auto trading? No, I haven't actually. Just some sort of there's something about the whole like auto trading world out there, and having something where they're trading it for me and they're executing it for me that I sometimes just don't trust. So that's just me personally, though. But I've heard that a lot of people are okay with that. Mainly the reason why is because if you've ever gone through some of the crashes, man, like you go through some crashes and there are just things that in the market that just break. If anyone remembers Flash Crash, Tom, I don't know if you tried to execute an options order during Flash Crash or anything like that, or even the
No, I
COVID
was
crash
flat
that we
at the
just.
time,
Oh yeah, so
fortunately.
so even the COVID crash or 9/11 or something like that, um, the spread in even something like a butterfly or even in a vertical was just completely asinine. It was huge. The spread was just massive. So if you sent in an autofill order at that moment when the mid price is bouncing sometimes beyond what's even profitable for the entire vertical. I mean, the market makers are just having a heyday. So, anyways, because there was so much panic, there was so much algorithms hitting the market all at the same time, and that's what we saw in Flash Crash. We saw that a little bit in COVID too. Sometimes you'll even get ETFs that will sell off more aggressive than the index itself that it tracks, right? Because they're using derivatives and auto trading as well. So there is this potential for the system itself to kind of have a problem in there. And I mean, call me a doomsday, prepper or something like that. But I mean, I like manually putting in my orders a lot of the times. I don't mind putting in an auto fill order, right? Because I put it at a price and I'm like, hey, I'm willing to do that. But as far as exiting my positions, it's kind of one of those things that is like that. If you trade like day of expiration trading too, there's a lot of systems out there that are derived by putting in good till cancel orders on the day of expiration, and so like that way it limits a certain amount of risk for trying to sell premium, and those things will get wicked like crazy, and you'll get filled, and it's not even a real price, right? It was like there's no way that option should have ever filled, but because you had a stop loss on there on an options order, it'll tag it, right? So there's just things out there. Automation is beautiful, but there are some times that a human needs to intervene, or at least have some sort of logic saying that that's not a real price, right? Like there's no way I'm going to accept that price for my order, because that's complete garbage. And if it is actually going to fill at that price, funny enough, I'll actually load up on my position is typically what I'll do, especially during crashes. So like if I've got a butterfly, like in the 2018 crash, man. So I had a like a butterfly that was positioned on the downside of the market during that crash, and the market just plowed through. Everything was nuts. It flattened everything out, and literally my butterfly was, I mean, it was down so much in a profitable zone for the butterfly that it was actually comical. So because I had some hedges on the downside on ES futures, I liquidated my ES futures intra night actually. And then that morning when the butterflies were totally garbage, I just bought a boatload of my own butterflies because they were so just ridiculously priced. And those are things that like an algorithm can't do. So anyway, so as far as trading goes, I don't know. I'm not there yet, but hopefully one of you guys can convince me. Just copies your trades into all accounts you manage under auto trade, as I understand. Oh, yeah, you're talking about I'm thinking, Serge, are you talking about where you do like a managed account for other people? If that's the case, we have a registered investment advisor that actually does that for us, that manages the Awaken the Sleep Well portfolio like that. So yeah, Serge, we actually already have that. That's not necessarily auto trading. It's just it's bucket trading or basket trading. And yeah, that's what I used to do at the hedge fund that I worked at too. We used Silex for executing all of our stuff, and it basically did the same things. You could just put it in big basket orders and then divide it out throughout your all of your accounts or all of your funds and stuff like that. So, but yeah, we already have that, and that's available at Interactive Brokers. I even use that myself, not at Interactive Brokers, but you can do it with TD Ameritrade too if you ask them and you set it all up. So that way you can trade just one account, knock it out, and then allocate it either after the fact or I think with Silex, I think you can even allocate it prior to, but I can't remember. Like set up fit not fit strict allocations. So yeah, always a good way to do things if you're trading multiple accounts. That way you're not individually going through all the different accounts. That's a pain in the butt.
Yeah, IB,
So yeah,
you can set it up based on ratios too. So you can say like this account gets 3 units, this one gets 2, this one gets 5, and then it'll take the percentage of the total for each account and just split it up for you.
there you go.
It's pretty nice.
Oh yeah. So if if we were to offer it like that, yeah, that might be a way to go about this is do something. Yeah, we'll figure out the long short. It might be actually to where we do something like that to where it comes out and it's maybe only a managed product or something like that. That way it's a little bit easier on the end user. I don't know, Tom. We'll go through that. But for right now, we're pushing a little bit more into options. My options trades go long and short. Um, and those it works out really well. And they have macro taken into account. They take some things into account, but of course they're purely SPX trades, the ones that I offered to the public. And then all of my individual trades, I'll go both ways on my individual trades on individual names. But I don't do individual stocks, not very often at least. So I normally stay in the ETFs or in the commodities and things like that. So uh, but all really good questions. Let's see, where are we at right now? Tom, what time is it?
It's 11 minutes to the hour.
49. All right, so we got some more time. Have you looked into creating an ETF for the awake or sleep well? Yeah, Ben, that's a great question. And yes, we have. Tom and I have actually had some conversations with some people. And then I looked into it as far as funding it myself. And it's there. It's kind of like doing a book deal. It's relatively high risk if you don't get the volume, if you don't get the interest in it, right? So if you've got a big name behind you, kind of like, Paul Tudor Jones or, Kathy Woods or I don't know, you could probably have an ETF that comes out with Elon Musk's name on it or something like that. It would probably do really well because it would sell really well.
Hey, it just has to
But
make a couple tweets and you're good to go.
right. But if you put an ETF out there that just works really well, it doesn't necessarily mean that it sells, right? There's a lot of really, really fantastic books out there that no one reads. And so to risk, about $2 million to build the ETF myself, yeah. So I'm thinking, I don't know, I might take on some investors and we might do it all and build it together, or someone that's been in that space. And I've kind of left my feelers out there for if anyone that has that ability to reach out to me. And I've reached out to a few other people, and we even had a conversation just the other day actually about it. So I'm looking into it. I'd love to do it. I really, really would, Ben. It would be the perfect way to offer this to the public. But right now we're just not there yet. I think the sleep well would just, yeah, with a good track record and a quantifiable approach. I just think it'd be awesome. I know. I hope so. Because it would actually reduce everyone's, well, I shouldn't say not everyone. There are some people that use the sleep well portfolio and the awake that are getting some amazing deals. Because the expense ratio on an ETF that's custom managed like that's probably I don't know 75 or 75 basis points, maybe 95 basis points. So let's just round it off at a percent, right? And we can do the math here really quick. So if you're managing $1 million, right? What's 1% of $1 million? Right. So that's what that ETF is basically charging within itself. Right now, no one sees it because it comes off of just the value of the ETF. So it's not like a fee is getting come out and hitting them. So that's something to kind of keep in mind. Whereas a situation like this, like what I'm offering right now, which is basically a flat price, and there are some clients that are managing tens of millions of dollars, and they're literally only paying, $900 a year or something like that for a wake. So it's a heck of a deal. So yeah, Tom, you and I would make a lot more money offering it as an ETF, trust me.
Oh
But
yeah.
it for right now, this is where it's at. As the track record gets longer publicly, and maybe there's some interest in it, or someone that joins it wants to team up with us and kind of go down that road and build an ETF with us and kind of partner with us, that would be a really fun project to work on. So yeah, it'll get there, Ben. I promise it will. It will eventually be an ETF.
All right, well, Wayne, I've got to run, and we can probably talk after this about the other project. But
Perfect.
it's probably a good time to wrap it up. We're
I
coming up
agree.
on an hour. So thanks for all the insights. Looks like the sleep well, I mean, it's going sideways, which is great considering everything else is falling off the face of the earth. So, look at the SPY. It's almost back to where it was when you started the sleep well back in 2020.
Yeah, I'm actually just completely just saddened by risk parity.
It's terrible.
Our
Look at that.
yeah, our par risk parity, all weather. I mean, that thing is designed with all of these kind of macros in place. And it just goes back to yet again, you can't have a fixed allocation that you just flatten out and put in history and say, hey, that's going to work forever in the future. Like, no, you need an adaptive portfolio that's taking into account what has changed, right? And what has changed right now is it's high inflation, low bonds, or sorry, low yields, and going through a global economic recession. Like a portfolio needs to handle that very differently than what it did in history. And that's why all of these portfolios are just getting decimated. And I really feel for everyone that's having that challenge. It's like being in an airplane next to a plane that's crashing and watching the other plane just crash. It's sad. So,
That's what
anyways,
happened with Payne Stewart's Learjet. Well, I think
oh,
it was Payne. Yeah, they took off from Florida to go, I think it was northwest, and they were climbing out and they lost contact with ATC, and they were level at pretty high altitude, like 40,000 feet, give or take. And
mm-hmm.
they scrambled some fighters to go take a look, and they pulled up next to it, and the windshield was kind of iced over, and they could see the pilot slump forward. So they had a decompression. So they were all dead, and the airplane just kept going until it ran out
Oh,
of fuel over, I think, South or North Dakota, and crashed. But the guys in
and
the
there's nothing you
fighter,
can do.
they just were there to watch. They couldn't do a thing.
Yeah, that's sad. There's just nothing you can do.
Yeah.
Ugh,
So
yeah,
stuff like that happens.
not cool.
All
Anyways,
right.
yeah, it's a real thing in financial markets, but we're preserving capital and we're primed and ready for some really nice upswings, and most likely it'll be bonds and gold next, and that'll be a really really fun time. We did just hit a new high not too long ago, and we're kind of on our way back up there. It'll be really exciting because normally during these high volatilities turnarounds, like in 2009, I think the portfolio did like, man, I think it did like 30-40% or so in 2009. So
Yeah,
that's what we're about to run into.
yep. So you're only down 4% right now from the all-time high versus the S&P's what, close to 25?
Yeah, and our all-time high was literally, I think, just
It
six,
wasn't that
7
long
weeks
ago.
ago.
It was right here.
Yeah, it was right
And
there.
and that was mid-August.
Yep. So that was our all-time high right there. So we're on our way back.
Hey. All right, Wayne. Let's wrap this up and then let's talk offline.
Perfect. Sounds good. It was great having you guys. We'll talk to you guys next time.
Yep. We'll see ya.